J.P. Morgan Chase & Company is the largest bank in America by assets. Bank of America Corp is the second largest bank by assets. Watch today's video to see what you can learn about the valuation of these two large money center banks. Hello everybody, this is Chuck Carnevale, co-founder of Fast Graphs, the fundamentals analyzer software tool, aka Mr. Valuation. And I've been studying the markets really hard here lately. We've seen an awful lot of turmoil. The market's crashing today. There's a lot to worry about, a lot to talk about, but since I'm always looking for value as Mr. Valuation, there's one sector or subsector especially that I've taken a keen interest in, and that is what I'll call the consumer finance or the financial sector, specifically the consumer finance sector. And what I did is I went and I reviewed the S&P 500 and I looked at all of the consumer financials in the S&P 500, and I discovered that there were 19 companies that I thought were especially interesting to look at, and considering that they're already trading at significant discounts to historical norms, as well as what I would call normal fundamental valuations based on operating results, I thought it would be fun to kind of take a look at. So I came up with 19 names, some of the finest, highest quality names in consumer finance, all of them trading on the S&P 500. So let's go ahead and look at the portfolio. First of all, I've got them listed in alphabetical order here, and you'll see plenty of names here: Allstate, Aflac, of course, Bank of America, Citigroup, Capital One, MetLife, Morgan Stanley, Wells Fargo, etc. And by order of high quality, you can see that a majority of them are A- rated or better, and all of them are investment grade. And again, I came up with 19 of these companies. But what's really interesting here is if you look at these companies, I found an interesting pattern that I wanted to share with you, because I do think the economy is a little scary right now. The market's certainly been scary here recently. And so I want to look for the safest, highest quality investments I can. I do like stocks that pay dividends, and I want to look for good value with good safety, good margins of safety, high quality, and look where I might be able to find some value. And I come up with these 19 names in the S&P 500 consumer finance sector that I thought I'd share with you. So let's start by setting some precedents here. So I want you to be on the same page as me. And one of the values of the Fast Graphs Fundamentals Analyzer software tool is it is a tool to think with, okay? It attempts to identify fair value and valuation. It uses formulas that are widely accepted to value a company. That's the orange line on the graph. But it also measures how the market has been valuing a certain stock or a certain group of stocks at the same time. And that's the blue line on the Fast Graph. Now, in the case of these 19 consumer finance companies that I'm going to be talking about here, what I want to make a point is the blue line is actually the line that I think should be given the most credence, because we're talking about safety and we're talking about trying to make investments that have good safety, good income, and have a margin of safety, as I often like to talk about. So let me establish something very quickly. I'm going to do it with Aflac, and I'm doing this in alphabetical order. I want you to notice that prior to the recession of 2008-9, which again was primarily predicated by, loose lending and finance, if you will, companies, lending money to people that shouldn't, that didn't have the ability to pay it back. And of course, companies like Aflac that invest in bonds and mortgage bonds, etc., were also affected. But what I want you to notice is, if I looked at the PE ratios of Aflac and most of these other stocks in this sector, when you look at them, you can see that the valuations, it was not uncommon to see valuations in the 18, 19 times earnings range. You can see that the orange line gave us a fair value indicator of 15 times earnings. That's what the orange line is. The blue line in this long-term maximum time frame that I'm using was 12.78. But I want you to notice in these first 6 or 7 years here, the market was valuing this at premium valuations. And then after we had this reset due to the Great Recession of 2008-9, notice that valuations were much lower. So if I look at the last decade, now I'm going to go 12 years here because I'm including a couple of years of forecasting data. And what we find out is, looking at Aflac, the first one, a company that used to sell at 20 times earnings, today you can buy it at 10 times earnings roughly or less. Now, currently, the blended P is 11.2, so it's essentially in line. Now, going to the forecasting calculator, the normal PE would theoretically be 15. That would be a normal valuation. But if I use the normal multiple, something closer to 10 over the last 5 years, this stock looks attractively valued. I want to point that out as we're going through this here, because I want you to be able to recognize that what I'm really trying to show you here is that these extremely high quality companies, Aflac is an A- rated company, is trading at a normal discount to its normal valuations and has been for the last decade. So if you're looking at valuing the stock, you ignore the 15 PE, but that does give you an upside target. There was a time when this stock and these stocks, as I'll go through them, traded at these premium PEs, but now you're buying them at these discounted PEs. So you've kind of got a built-in margin of safety. Now, I want to do something else here also. I want to point out something that I failed to point out in the last tutorial video on how to use the historical graphs. Recognizing that they are dynamic and you can change time frames very easily, and you get, different calculations when you do that, as you can see. But what I want to point out is if I go up here and go to the question mark up here in the top of the fast graph, there are keyboard shortcuts. And one of the shortcuts that I'm going to illustrate today that I failed to illustrate in my last tutorial video was the left and right arrow. Okay, it will allow you to advance these stocks, and you can then look at a large group of stocks. Like I'm going to look at 19 here very, very quickly. Now, what I'm going to do is I'm going to go into, I went into the portfolio here, and I'm going to go into the summary, and I'm going to start with Aflac, and that's my very first company. And again, I've got the high valuations, and now I've got the low valuations, but now I'm using the keyboard. I'm not using my mouse anymore. I'm using the right arrow of the keyboard, and watch how quickly I can go through these 19 companies. The first thing I'm going to do is just illustrate the value of that. So I'm just clicking the right arrow. Here's Allstate, 11 times earnings. Here's Bank of America, which I featured in the beginning. It's growing at almost 27% a year since this reset, and it's only trading at 18 times earnings. If I look at Citigroup, it's trading at around 11 times earnings with a 6% growth rate. But look how quickly Capital One, 10 times earnings. Discover Financial, about 10.8 times earnings. Globe Life, which I featured in a video recently, is still held up. It's an A-rated company that's still trading at roughly its, fair value of somewhere between 14 and 16 times earnings. The normal PE for the last 10 years has been about 14. Goldman Sachs trading at less than, 11 times earnings historically here. Hartford Financial trading at 11 times earnings. JP Morgan Chase, the largest, diversified bank in America, trading at under 12 times earnings, or around 12 times earnings over the last decade. Lincoln National, life and health insurance company, A- rated, trading at 9 times earnings historically. And you can buy it cheaper today. MetLife, 9.5 times earnings. Morgan Stanley, 12.8 times earnings. Principal Financial Group, 11.27 times earnings. Prudential, the great deal, the Rock, A-rated company, trading at 8.74 times earnings. Synchrony Financial, triple B- rated, trading at 10.8 times earnings. Travelers, 12 times earnings. U.S. Bancorp, now regional banks, and I consider kind of U.S. Bancorp, it's a diversified bank at $70 billion in market cap, but it's almost acted like a regional bank most of the time. It trades at around 13.5 times earnings, and it's A+ rated, and that might, speak to why it does. Wells Fargo, triple B+, and, once again, we see it traded. So I can go through these companies very, very quickly by using these arrows here, and that's what I want you to see, that I can go through it very quickly. So I want you to see the power of the tool, first of all. That was one of my first objectives here. But I'm going to go back now. I'm going to go and look at the views of these companies. I want you to see some things here. They're all financials. I want you to notice if I look at sub-industries, they're consumer finance, diversified banks, a couple of investment banking and brokerage in Wells Fargo and Goldman Sachs, a lot of life and health insurance, a multi-line insurance, and 2 property and casualty insurance in Allstate and Traveler. Okay, but again, very high quality, all investment grade. But going back here, I want to go through this now a little slower for you. And, I'm going to use the arrows again. So I've already done Aflac for you. Here's Allstate. You can see that this one is traded at a discount, about 11 times earnings most of the time. And now this company has had a negative earnings growth this year, which has caused some weakness in the stock, but it's expected to recover dramatically. I want you to notice the yields of these stocks. Again, I'm going to go to the 12-year time. You can get 2.5% in Bank of America. It's been growing very, very fast. It's expected to continue growing at double-digit rates for the next couple of years, although we are expecting a down year this year. And that's something else I want you to be careful of when you're looking at these. Always look at the individual growth rates. For example, if I go into the forecasting calculator, I get a 7% average growth utilizing these 3 years. However, I got a minus 11 and then a 20 and a 13. So really, what I want you to focus on is this 20% and 13%. And again, we're trading at a normal multiple here for the last 5 years. This gives you a tremendous opportunity to make money in Bank of America stock. Going through, I can get a 4% yield in Citigroup, trading at historically 11 times earnings. That's the blue line. What I want you to do is I want you to look at these lines and see that there are times when you could buy it cheaper or less than 11 times earnings. And today you could buy it at 6 times earnings, a blended P of 6 times earnings with a 4% yield. And again, a negative year expected this year, but then it's expected to have another slight negative year and then start growing again at double-digit rates. And therefore, if you're looking out a couple of years on a stock like Citigroup right now, you could generate 30% rates of return if it only traded at 11 times earnings. That's a what-if scenario. So Citigroup looks very attractive. Capital One Financial's got facing a couple of down years. That explains the stock price. But you can buy this stock at under 5 times earnings with a 2.1% dividend yield. Discover Financial, you can buy at a blended PE of 6 times earnings. It's been trading at 10 times earnings. There, ergo, goes your margin of safety. You can get, a really nice pop if this stock were just to go back and trade at its normal, valuation. You could make a relatively substantial amount of money here owning a stock like Discover Financial Services, over 25% a year. If it just goes back to its normal post-Great Recession discounted PE, I want to emphasize that. It's discounted PE. Globe Life, I covered for you in a previous video. Goldman Sachs, infamous stock. You can buy it at a blended PE of 8.1 times earnings, a dividend yield. It's actually over 3% considering the stock is down today. So you can get some really nice, attractive yields. And notice how the dividend has increased year after year over this last decade. That's a very important factor. The stocks, Goldman has raised their dividend at a very attractive rate. If I look at Hartford Financial, once again, we see a stock that's been trading at around 11 times earnings. You can buy at 9.7 times earnings with a 2.5% roughly. Again, given the fact that the stocks are down today. JP Morgan, you can buy it with over a 3% dividend yield, a blended PE under 10. And, a margin of safety. This has been trading at 12 times earnings. All it's got to do is go back to 12 times earnings, and you can make a substantial rate of return over the next couple of years, double-digit 18 or 19% with a 3% dividend yield. Lincoln National, you can buy at 6 times earnings. These stocks are already beat up. We're all worried about what's going to be happening in the market. I believe there are opportunities for those of you who don't want to wait and don't want to hold cash right now. You can get 3.5% dividend yield in Lincoln National. It's an A- rated company. You can buy it at 6 times earnings, with an earnings yield of 16.27%. I mean, that's incredible. MetLife, is another high-quality A- rated company. Earnings yield almost 12%, dividend yield just over 3%, given today's weak market. Morgan Stanley, you can buy it at a blended PE of about 12.5 times earnings. That's roughly normal, but it does offer a 3.4% dividend yield. and an earnings yield over 8%. And this is Morgan Stanley. So, that's obviously a high-quality brokerage firm. Principal Financial Group, you can buy at a blended P of 12 times earnings, dividend yield over 3%. Blended PE is 12 times earnings today. This is another one that gives you, a already discounted valuation. Prudential, the mighty Prudential, you can buy at 8.7 times earnings, earnings yield of 11.46%. You've got, again, there's a reason why the stock prices are down. But if you're looking forward, there's a lot of opportunity in buying the stock, and you can get almost a 5% dividend yield buying Prudential today. Synchrony Financial, 2.7+% dividend yield. You can buy it at 5.4 times earnings with an 18.4% earnings yield. Now, earnings are going to drop a little bit, so that earnings yield might come down a little bit, but it's still going to be double-digit earnings yield in the future. Travelers, you can buy today at about a 12 PE with a 2.25% yield, A-rated company. Again, very inexpensive with a good margin of safety already built in. U.S. Bancorp, one of the A-plus rated, leading banks in the country. You can buy this stock at 10 times earnings with an earnings yield of 9.68% and a dividend yield of approaching 4% right now. And then, of course, last but not least, Wells Fargo. Dividend yield 2.6%. You can buy it at 10.6 times earnings. Now, they did have some issues and did cut their dividend recently. But again, if you're looking to the future, there's some really attractive, names in this group. They're very high quality, as I mentioned. All of them are investment grade rating. All of them have attractive earnings yields, with the exception of Allstate. But Allstate is the one that had the down year, the big down year in earnings right now, but is expected to recover dramatically, so I wouldn't fret too much about it. Anyway, this has been Chuck Carnevale, a.k.a. Mr. Valuation, showing you some real bargains in this very dangerous market now in the consumer finance. These are all S&P 500 companies. They're all very high quality rated. You can get some really interesting dividend yield, some really good dividend growth, and some really low valuations. If you enjoyed this video, ring the bell, give me a like, subscribe to the channel if you haven't already. I look forward to talking to you guys again real soon, and I've got a couple of tutorial videos in line for you. For those of you who are already subscribers to Fast Graphs, and I can't imagine why you wouldn't be, by the way, although I am biased, but the point is, I'm going to be showing the subscribers some additional tutorials on how to better utilize this tool so you can make more prudent and ultimately profitable long-term investment decisions. Thanks for watching, everybody.